Hi all, we are Stream 13 Group 17, and today we will be observing currency pairs Australian dollar to the United States dollar and Australian dollar to the Japanese yen. These currency pairs are in the top 5 in terms of trade frequency, and the countries these currencies belong to are also in the G20 due to the highly industrialized status. So I will begin with commodity prices. Australia's economic strength is largely based on the export of natural resources, accounting for nearly 64.1% of all exports according to the Department of Foreign Affairs and Trade, as you can see with the list on the right. These resources are mainly iron ore, coal, gold, and natural gas. Noticeably, the Australian dollar significantly weakens against the greenback during times of low iron ore prices, as you can see on the left. This appreciation has occurred during the early 2000s until 2007, and most recently, the time between 2013 and 2017. This result is also visible for observing Australia's terms of trade index. When the index is high, as you can see on the top left, the AUD is valued higher against the USD if you compare it to exchange rates. When the index is low, the AUD is also subsequently lower against the United States dollar. Commodity prices are usually affected by main importers of the products naturally. Therefore, if export partners are facing a recession or have lessened their demand for Australian goods, it is likely that Australian commodity prices will fall. Currently, according to the Department of Foreign Affairs and Trade, China, Japan, the United States, the Republic of Korea, the United Kingdom, and India, in that order, are top importers of Australian goods, which are mainly natural resources. During the GFC, Australia managed to avoid a recession due to its key exports remaining highly demanded, especially from China at the time. At the time, China was experiencing high growth. Hence, the AUD was able to quickly rebound against the greenback. Observing this phenomenon, it is apparent that the Australian dollar is extremely reliant on its trade partners. Thus, a possible depreciation against the USD could be apparent in the upcoming 3 to 6 months. According to the RBA, Chinese demand has also reached a peak regarding steel production. Therefore, a reduction of demand is imminent, and that may lead to weakening of the Australian dollar against the USD. Depreciation against the greenback can also be attributed to rising import values. Australians continue to spend more and more overseas. Therefore, we can see the weakening of the Australian dollar in regards to that. Consequently, developing states, especially in India, could take the helm in terms of steel production, as prices slump due to the lack of demand, but this is unlikely in the short term due to current Indian production. The Australian dollar's strength against Japanese yen can also heavily be attributed to the commodity prices factor. Japanese Iron and Steel Federation has recorded a reduction in steel production, also indicating a slump in demand from Japan. Now, this is possibly due to a wider trend of an economic slowdown. The yen, like the USD, will follow a similar trend where they both appreciate against the Australian dollar as a simple result of lessening demand and falling commodity prices. Now we'll move on to Risto.
Neil. Alright, so the second determinant of exchange rates that we're going to focus on is inflation rates. So inflation is basically a general increase in prices and a reduction in the purchasing power of money. So if we're under the assumption that Australia has a higher inflation rate than its trading partners, then there'll be two subsequent consequences. So the first is that Australia will face a reduced demand for its exports, resulting in a decrease in demand for the Australian dollar. There we go. So the second is that due to the rising prices of goods and services in Australia, there will be a greater demand for imports. This will result in more supply for the Australian dollar. And as a result of both of these consequences, it means that Australia's will have a higher inflation rates than its trading partners and will depreciate against the currencies of these respective countries. So, the purchasing parity theory states that exchange rates between countries are in equilibrium when the purchasing power in each of the two countries is the same. So in the long run, this theory determines that the exchange rate will adjust due to importing and exporting of goods. So basically this means that due to having some countries produce goods cheaper than others, they'll be bought where they're cheap, transported, and then sold where they're more expensive. So this results in the adjustment of exchange rates in accordance with the purchasing parity theory. So looking at the Australian dollar in comparison to the US dollar, it can be said that it will depreciate in the near future. So in December 2006, the US had an inflation rate of 2.2%. This was in accordance to the United States Department of Labor, the Bureau of Labor Statistics. So whilst Australia was at 1.5% according to the RBA. So in March 2017, the inflation rate in the US fell to 2%, while the Australian inflation rate drastically rose to 2.1%. Finally, in June, the US inflation rate continued to fall to 1.7%, whilst Australia's inflation rate also fell, but only to 1.9%. This shows that while the Australian inflation rate has been fluctuating in recent times, the inflation rate in the US is constantly falling. So as a result, it is reasonable to assume that if this trend continues in the future, the Australian dollar will depreciate against the US currency due to the higher rates of inflation. And similar to the US dollar, the Australian dollar will likely also depreciate against the Japanese yen in the future. So, according to stats from the Japanese Bureau of Statistics, in December 2006, the inflation rate of Japan was at 0.3%, while it only rose to 0.4% in June of 2017. So it is likely that when matched against the Australian dollar, which is constantly fluctuating at about 2% inflation rate, the Japanese yen will definitely appreciate. Next.
So now we're going to move on to the determinant of interest rates. So relative interest rates are a determinant for the value of currency for a country. Generally, high interest rates tend to increase the value of a given country's currency due to the increase in traction of foreign investment that it will create, which will increase the demand for their currency. However, the effect of inflation needs to be considered when viewing such rates. This is due to the interest rates being adjusted to include inflation rates. In such cases in which interest rates is higher due to inflation, it will result in a depreciation rather than an expected appreciation. So as you can see, the Australian interest rate is currently at 1.5%, and the United States dollar interest rate is currently at 1.25%. But according to data from the Reserve Bank of Australia and RBA Governor Philip Lowe, they have made it clear that the Australian rates won't be moving for a considerable period of time in the future. The US, however, has shown a trend that has predicted to increase in interest rates compared to Australia's predicted to stay constant. As you can see from this article, in the last 3-6 months, there has been 3 cases of interest being increased in the US. And as you can see from this article, you can see that Philip Lowe made it clear last week rates will not be moving, and rates have not moved since August 2nd, 2016, so almost about a year. Furthermore, the Australian dollar's inflation rate is currently at 1.9%, and the United dollar inflation rate is currently at 1.7%. So it is predicted that Australian and US interest rates both will decrease in the future. Therefore, the rise of interest rates for the United States dollar will not be due to high inflation, and therefore it can be concluded that the AUD will depreciate against the USD. In this matter, the Australian dollar against the Japanese yen, you can see that the Japanese interest rate is at negative 0.1%, and the Australian interest rate is at 1.5%. In the future, the Japanese yen is expected to decrease, while the Australian dollar is expected to remain constant. And the inflation rate for the Japanese yen is also expected to increase, while the Australian dollar inflation rate is expected to decrease. Therefore, since interest rates are made constant, similarly, and inflation is getting higher for Japan, you could say that Japan will actually appreciate against the Australian dollar.
So, in conclusion, based on the 3 determinants of exchange rates, commodity prices, inflation rates, and interest rates that we've analysed so far, we have varying results for the Australian dollar against the USD and the Japanese yen. So we've come to a consensus that in the next 3 to 6 months, the Australian dollar will depreciate against the US dollar. But for the Australian dollar against the Japanese yen, we have conflicting views. But due to the high impact of commodity prices on Australia's exchange rate, we determined that the Australian dollar will depreciate against the Japanese yen. Thanks.